like to move into now how to really start working on preparing a cash flow. As I said earlier, it's I've been doing this for 35 years. It's been, I think, one of the key tools that I bring to my clients, even in good times. I've worked with clients where they actually had more cash. They had more cash in their business than they needed, and to me that was not necessarily a good thing, because you're putting it at risk, what we call creditor risk, but actually it's at risk all the time. It's in your business. So by doing cash flow forecast, we were actually able to convince them that they didn't need all that money, and that they should be taking and getting it out of the business to reduce their risk with it. So let's talk about the cash flow forecast. And basically, when we're doing a forecast, at the highest level, all we're doing is we're saying, here's my beginning cash. I'm going to add all of my sources of cash for a period or periods of time. And then I'm going to deduct all of the uses of cash. And that's going to tell me what my forecasted cash balance would be. I will tell you that having an operating budget makes this whole process of forecasting a lot simpler. You're going to have to go through the same type of looking at your business in terms of where your sales coming from, how much in sales. You're going to have to look at your variable expenses for cost of sales. You're going to have to look at your fixed expenses. So having an operating budget already in place will make this a lot easier. In fact, when I work with my clients, when I'm preparing an operating budget, I call it a profit plan, simply because I think it's easier. People get on board to put together a plan to make profit, where operating budget sounds pretty dull and boring. So basically the same thing. When I do the profit plan, I always include the forecasted cash flow for the same period of time. So having the budget, as I said, makes it a lot easier. So let's look at what we need to be looking at when I talk about sources. So sources we really have to understand how cash flows through our business, not how profit. So for example, if we are selling, for example, on an e-commerce, then our cash sales are going to be the same. They're the same number. Revenues and cash flow would be the same, because we're collecting immediately. There may be a day or two delay, but effectively immediately you're collecting the source, the cash from the sale. As I look at businesses, these are common, but not every business is going to have every one of these, but most businesses will have one or more of these. Deposits. Some business run on construction, again, where we are getting customer deposits before we start work. You'll see that both in residential, commercial construction. I would say some service businesses will also collect deposits on contracts before they start work. So that's a source of cash. Even though it's not revenue, it is a source of cash for us. Obviously, accounts receivable collections are a big source of cash for those of us that are selling on time or credit. Accounts receivable collections is a real challenge for forecasting. I have spent a lot of time trying to look at history to determine how to predict receivables, and a lot of times what I end up doing is looking historically and saying, on the average, for the last 3 or 6 months, they've been collecting 68% of their receivables every month, or 82%, or whatever that is. I have recently been working with a company that has some software that actually goes down and looks at it uses algorithms to go down and look at individual customer level, their kind of payment habit, and be able to forecast collections into the future. And I've been monitoring that, and I've been pretty impressed. Over a four-week period, their forecast, what they forecast the actual collections runs about 90 to 95%. So for those of us that are doing forecasting on a regular basis, that's good news. So I just understand that you'll get better with forecasting your sources of AR collections. The more you do it, the more you analyze it. Some companies have notes receivable payments out there. That's a source of cash. We've got loan proceeds. I'm sure many of us, hopefully many of us on this call, have got the PPP loan. So getting those loan proceeds would be a source of cash. It could be a working capital line from your bank. It can be a capital injection. It may be that you have to either through investors or yourself have had to put money back into your company. So that would be another source of cash. So this is what I'm showing you now is just an excerpt of how I set up a forecast. It's pretty simplistic. It's just identify the sources, and I'll break down the sources by month. But I think what's important about this too is that, and obviously I use Excel for this. I have not found for most businesses a off-the-shelf model that works for businesses easily and does the documentation that you need to of your assumptions. So I've used Excel. I start with a template that I've developed and then just modify it for each client. But each of these different sources would have a tab in the Excel workbook to really document the assumptions about, well, where did the cash sales come from? Who was I planning on getting customer deposits from? And what was the calculation on that? So each of these then would have an assumptions page tied to it. And the reason for that is that when you first start doing cash flow, it's going to be reasonably accurate. And what's going to happen is that as you begin to monitor what actually happened against your assumptions, you'll get better at forecasting, and therefore you want to have your assumptions in place and documented so that you can go back later on as you're evaluating it and saying, well, wait a minute, my cash flow didn't come anywhere close to that. What was the assumption that I made? So that's to me the important part of getting this set up. So let's look at the uses side of, how do we use cash? Where does cash go? It certainly goes more quickly than we like it a lot of times. So let's look at the big components. Cost of goods sold. This can be cost of services / inventory. So we need to be able to say, okay, it's not so much my cost of sales percentage of my sales revenue. It's really related to the inventory that I've got to replace for the cost of goods sold. That is the cash component, not the profit or the expense component. And so again, it really takes a different mindset to examine your cash. Examine your business as the way that cash flows through it, not profit and expenses. So this number, inventory, for some of you now with what's going on and reduction in sales, You know, the inventory number, you may not be replacing inventory at the same levels that you were before. So it would be important to know what that impact is as you're seeing your sales decline as well. Payroll taxes and benefits. That's the obvious. We all know that employees are the most expensive part of most businesses. I like to, when I'm doing a budget, you'll see that the next several categories are the way that I classify my expenses on the income statement. So it's a lot easier to, rather than your uses listed as, you know, 112 different line items, I tend to classify them like what's the cost of my payroll, the taxes related to it, and any benefits that I'm providing. And then I'll take a look. Next category would be sales and marketing. That could include any marketing that we're doing, any advertising, anything that we're doing on the internet, sales commissions and everything. So sales and marketing is another big category. All businesses have those. General and administrative expenses. This is a catch-all for what I would call your fixed expenses of your operation. This is going to be your rent, your utilities, your office supplies, all of those expenses that are relatively fixed just to keep the doors open in your business. And then finance expense. How much are we paying for interest on the loans that we have now, or as we're doing forecasts, if we decide that we want to take out, we need a loan and we can get a loan, what's the cost of that loan in terms of the interest that it's going to cost the business? We want to capture that. We'll also want to capture credit card payments. You know, a lot of businesses I see have multiple credit cards and are using that to fund their operations. Well, those have to be paid back. So what is that cash outflow per month that's required to get your credit cards paid to zero or reduce them? And then loan payments. This is kind of the other part of the finance expense. You know, when we're paying a loan on time, we're paying both principal and interest. So we would want to capture the interest in the finance and the principal in the loan payments. And then hopefully we're taking some level of distribution, a dividend out of the business. We want to track that. I've got companies where, again, particularly during these difficult times, the owners have decided not to take a salary unless they were qualifying under the PPP loan. So they may be taking distributions just to get money into their personal pockets. And then this is another use of cash that a lot of times go unnoticed, because most of the time we're looking at just my operations. But if we need to spend if we have capital expenditures that we're planning on purchasing, it could be a change in your software, it could be your hardware, computers, could be manufacturing equipment, all the things that we talked about earlier. So we want to make sure that we're capturing those in our cash flow, because they are a use of cash, even though they are not an expense of the business. So this is again, this is a snapshot of what the use side of the forecast would look like. And again, I would have, for each one of these categories under uses, I would have a tab in the Excel workbook that would document where these numbers are coming up. And then at the very bottom, this is what I was saying earlier, is that there's my beginning cash of $63,000, and then what I do is I monitor, did I create a surplus or deficit during the month? Did I add cash, or did it take cash to run my operations? And then across the very bottom, I'm calculating what my projected ending balance would be. And in this case, you can see that their cash balance is going down pretty quickly. I think I showed in May that they had gotten a PPP loan in this example. So one of the things that I would look at here is that I would say, okay, in July, we have a burn rate of $33,500, and by that I mean that it's taking our cash flow is $33,500 negative in the month of July, and unless we do something to change that with an $8,500 cash balance, we're not going to be able to sustain ourselves. So by having done this forecast back in April, I would have been looking at July and saying, okay, what are the things that I could do in May and June so that that doesn't happen in July? And that's what the real benefit of the forecast is it really helps me look into the future based on these sets of assumptions to give me an idea of, is there something that I need to do now? What's driving either my positive or negative cash flow, and what do I need to change in order to convert this into a positive cash flow? I understand easier said than done, but what this does is that it's better to know it in April than it is in mid-July that we're going to have this kind of issues. One of the things that I do as I'm working with my clients, just so once this template is developed and once we've documented assumptions, I have found that if there is a bookkeeper or an accountant, that I can usually train them on how to populate this. But to get them to develop this on their own is just not a skill set that they have. They're typically transactional, and they're looking at the business from a profit and expense as opposed to cash flow. So don't assume that you can turn this over to your bookkeeper and or most accountants to prepare this. You will definitely, as the business owner, need to be involved in order to make sure that things are being captured correctly. So, the next piece of business here is, so how often should I be forecasting my cash flow? And I think that times have changed. For all of us, I'm with my clients, I'm counseling them that they really need to prepare two different scenarios in their cash flows every time we do one. One is what I call the hopeful cash flow. This is what we think could happen based upon what we know today. And then I have what I call the coronavirus scenario, which is what's that worst case look like? What if not only do we quit making sales, but collections slow down for receivables, or it takes us 90 days to get our pipeline filled? So I think that at this point, whenever we're doing a cash flow, we need to be doing two cash flows. And one is the hopeful, one is what we think can happen with the changes that we know about, and then the next one is really kind of what's the worst case. So I would tell you that it's the criticalness of your cash that determines the frequency of how often and for what period of time you should forecast cash flow. Again, with my clients, I'm recommending that they do a 6-week, which is a near-term cash flow, where each column would be a week. So they would have 6 1-week looks into the future, just to make sure that there aren't any negative cash periods during that 6-week. So if it's critical to you, which it is to a lot of businesses right now, and for those that aren't, that are less critical, The 6-week is probably not necessary, but what I do recommend is, even if you are doing a six week, that you also prepare on a monthly basis, that you prepare a 3-month forecast. So here we are in June. I already would have June, I would have a forecast that would have already been done in May, that would have been June, July, and August. And then by July 1st, I would have a July, August, September one. So I'm always looking out 3 months. And again, having this hopeful and pessimistic or coronavirus scenario for you to be looking at. So it is a lot of effort to do this, but I think once you get your template set up for your business for forecasting, it really does not take that long to keep it updated. And the thing is that it becomes a great tool, especially now with cash being a challenge for most businesses.